Welcome to the Physician Wealth Med podcast. It's wealth medicine for doctors. If you're a doctor and you have no time, it looks like you found us just in time. This podcast is for all doctors who would like to work on their personal wealth, but do not have traditional hours to do so because they have no time. We're here to jump into topics that will help you address your wealth both inside and outside of your practice so that you can live the life of significance you're dreaming of. You'll hear from your peers, you'll hear from industry professionals, and your host and wealth advisor, me, Kevin Sullivan. This is your time. Now let's get started with today's podcast. Welcome to the Physician Wealth Med podcast. We call it a wealth podcast for doctors. And one of our main goals is to help you create wealth inside and outside of your practice. And we have a very special guest with us here today from Bancorp. His name is John
Profitlich.
Profitlich. I'll get that. This is why we have an editing button there, my friend. He's a director and he's also a business development officer for the Northeast region in the institutional banking for Bancorp. And we're so glad that he is here today. We want to talk to you about a subject today that I think you doctors would find very informative, very valuable, because one of the things that a lot of doctors have and there's a huge need for is access to capital. And how do you stop your day in the middle of everything that you're doing, try to go down and fill out loan applications and use credit scores and try to find out ways that you could get capital when you need it. This is a beautiful thing when you talk about securities-based lending and using your investment portfolios for access to cash without actually selling the investments. And it's very neat and clean. It's very easy. And there's certain criteria that you have to look at to know how to do this. So we just thought we'd bring the expert on to talk to you about that today. So John, welcome to the podcast.
Thank you, Kevin.
Hope that was okay for an introduction, but tell us who you are and what you're doing, why you do it, and who you do it for. How's that?
Sure. So thanks, Kevin. Thanks for having me on the podcast today. I appreciate you including in this topic. I've been in banking and wealth management for over 35 years. So talking about how this has helped out many different professions, whether you're a doctor or any type of profession you have, on access to to utilize capital that you have to create leverage off of that capital without creating any type of taxable events, if you want to call that, for having to sell appreciated assets. So, that's why we created the securities-based line of credit at the Bancorp. I cover the Northeast for the Bancorp. I talk directly to professionals and individual investors and wealth management advisors and help them out with practice management and providing different resources like securities-based lending as an option for their clients to access cheap capital, if you want to call that, with pledging their securities in their account. And I'll tell you a little bit about that. We offer lines of credit against securities accounts that are owned by individuals, joint ownership, trust ownership, both irrevocable and revocable trust, corporations, S Corps, C Corps, LLCs, foundations, and endowments are some of the titled accounts that we are eligible to lend against collateral and securities that are held in those accounts. It's a pretty simple process. Everything is digital. Everything is online. So there's no paper going back and forth. These lines we do a credit check through the underwriting process. We don't do it for businesses. We only do it for individuals and revocable trusts that are in the tax ID of the owner. Once the line is established and is approved, once we go through underwriting, that credit line is not reported to the credit agencies, which is key. So it's not showing up as any type of usage of debt, and it just doesn't appear. So there's no reporting through credit agencies after the line is set up. The only thing that happens is we do check credit, and that credit check lasts on a credit report for 90 days. Once that 90 days is over, it gets removed from your report. So a lot of times the use of these lines for individuals, joint owners, LLC, corporations might be for real estate transactions. That seems to be the highest usage of this. And the reason why they use this for real estate transactions is because you avoid the mortgage process, which could be cumbersome. And you look at a timeline too, as far as how long it takes to get our particular line of credit, securities-based line of credit, set up. The average time for setting up a line of credit is about 4 to 5 business days, as long as everything goes smoothly through the process. We do have DocuSign built in, so DocuSign that's executed through opening up these accounts. And we see this used for professionals like doctors in the case where they might have some of either their personal assets invested or they have some of their business assets invested. There is no cost to set this up. There's no fees to set this up. It's basically a feeless transaction. When I talk about mortgages, you have closing costs. When you talk about commercial lines of credit for businesses and practices, they charge you to have a line in place. They have quarterly reporting for auditing. This line does not have any audit trail. There is no requirement for documentation. So that's a huge cost savings when you don't have to tap into a CPA to ask them to provide quarterly reporting and auditing for businesses to commercial banks. So there's a significant savings there. It's really used well in the marketplace. We see it used for multiple purposes. It could be for equipment purchases for practices. It could be for payroll short term. It could be for covering receivables for 60 to 90 days. So there's many uses for it, the securities-based line of credit. As far as the interest rates, they're very competitive. They're prime-based interest rates. Prime is at 8%. I think the Fed is making an announcement as we speak on this podcast. Yes. And most likely, it looks like they're going to reduce by 25 basis points. So the prime rate would go down to 7 3/4. In that case, you're borrowing below prime. We charge interest only on the line of credit. That's a required payment on a monthly basis. It's billed monthly, and it's charged based upon the average loan balance on the line of credit for that month, based upon the interest rate charge. When rates do go down, the rate will change on the account the next billing cycle. I think that's all critical information to know about how the product itself works. And application-wise, like I said before, you can use it for multiple uses. There is no real restrictions on the use of the capital other than you can't go out and buy additional securities. So it's not a margin loan. It's a Reg U loan, which allows you to use it for other purposes outside of buying securities.
Let's unpack this a little bit. Going back to one of your first statements about the credit. It's on your credit for 90 days, but that'd be a soft hit, right? That's not a hard hit.
It's a hard hit.
It's a hard hit. Okay.
It's a hard hit to credit. It's just because we go to multiple credit agencies, so the consolidated reporting gets hit as a hard credit. But okay. It appears for only 90 days. When I give a disclosure on that and I say if you're involved in a lot of times for real estate transactions, it's a bridge solution, right? Yeah. It's a bridge solution between a sale and a purchase. Based upon a sale and a purchase, there might be a 2-month window, and that's where this line of credit is used. So if you are going to use the bridge solution, I would have this line in place about 3 to 4 months before the transaction, just so that hard credit check is removed from the credit report when you go through a mortgage process.
Good point. Tell us about the actual line. When you pay it back, the line becomes available again and all that. Talk about those dynamics.
Sure. So it's an interest only. So let's just say, for example, you have a $500,000 account and we give you a line of credit of 50% of that $500,000. So you have a line available of $250,000. And you want to use it in 2 weeks. The preference for usage is via wire. We do not charge for wires. Let's just say you need $100,000 to cover some capital costs in the business. You could have the money wired to your business account at your local bank, and then you could pay it back at any time. The only thing you're required to pay if it's over an extended period of time is to pay the interest only on that. It's very similar to a home equity line of credit. Except with our line of credit, there is no draw period end. It's an evergreen line of credit. So as long as the collateral is posted for credit, there is no timeline. There's no end date to the line of credit.
That's very important. So if you're taking notes, that would be one that you can use perpetually, which is great. You mentioned margin. So tell us about how this is different than margin. Why wouldn't they just do it on margin?
There's a couple of reasons why you wouldn't do it on margin. The margin accounts let you take more leverage against your account. So what I mean by that is you could pretty much max out on your margin, but then you're subject to fluctuation of the valuation of the account, which will create a call situation for you.
Right.
In our situation, we have in most cases, anywhere from a 30 to a 50% buffer on market changes in our product. And then there's also a big difference in rates. The margin call loan rates, as they call it, the broker call loan rates, are usually and typically a lot higher than the prime rate. If you did a $500,000 margin loan or a margin line, you're probably going to be charged on average 2 to 2.5% higher than our line of credit would be.
Yeah. And that's why I wanted to really distinguish the difference between the two. So you don't have to pay the closing costs by using these securities lines of credit and all of those benefits you were talking about. But also, rather than using margin, here's another way that you can have access to the funds even less of a cost than that. Tell us about the eligible securities. What's eligible? So you get a portfolio, you're looking at someone's portfolio. What is eligible and what might not be eligible for consideration for the line of credit?
That's a good question. Your typical accounts hold equities. Any equity that's traded daily and priced daily and is over and trades over $9 is eligible. So let's just say you have $50,000 worth of Apple, $50,000 worth of Amazon, and $50,000 worth of Google. You have a $150,000 account, which I wouldn't recommend that concentration, but I'm just using it as an example. You would have a line of credit of $75,000 based upon that 150. Mm-hmm. If you had a diversified portfolio that included fixed income instruments like corporate bonds or any type of corporate debt, as long as the rating is A or better, which could be posted as collateral, we give an 80% release. So if you have a $100,000 bond, you can get $80,000 in a line against the corporate bond, as long as it's A paper or better. That includes mutual funds. So mutual funds can be posted as collateral. ETFs, equity, treasuries are a 90% release. You can also, any cash that's held in the account is 100% release. We do not lend against structured notes. We don't lend against any type of cryptocurrency. You know, the riskier assets, we're not going to provide a line against those assets.
And as long as the investment account is still up and running, you've got your line and the reporting, and so that they know that the account's still there, is all done in-house with Bancorp?
Yes. So we have a direct link to where the assets of custody, where the custody are. So if you have a Fidelity account, a Schwab account, an LPL account, or any of those custodians, we have a direct feed of pricing on a daily basis. So that's how we monitor the collateral, and that's set up through the application process.
Absolutely. I know we got a client that recently used this service, and it was so smooth to be able to get the funds that they needed to do the projects that they had to do. And it's something that they found very valuable, very quick and efficient. I was actually stunned a little bit about how quick and efficient it was, because you hear this, hey, if you apply and everything goes well, 4 to 5 days, but he's talking the truth. It was a very smooth client experience, and that's what we try to deliver for you. So anything else you'd like to say about the securities-based lending part of things?
Like I said before, I think it's so heavy real estate related product. There are purposes. So in other words, on the application, you have to tell us what the purpose is of setting up this line of credit, right? That's a requirement on all credit applications. And there's different categories, some categories of use or purpose. We see it a lot for quarterly tax payments. So people use it for tax payments, especially businesses. We see it used for college education funding. We see it for, like I said, real estate before. We look at it for daily liquidity. We look at it as a substitute to home equities. Yeah, the purposes are listed on the application, but those are the most frequent uses that we see. We see a lot of businesses, a lot of professionals use it for quarterly tax payments.
Yeah, and another use too for medical practices too that I've seen that this would be good use for is acquisitions. Just had the pleasure of helping some physicians out in Colorado, a younger doctor purchasing a practice of the older doctor, and the cash flow that's readily available to be able to give you that cash just to take care of what you need for maybe the down payment, for equipment. All of those things come into play where you can get that money and have it accessed really quickly without the payment at the end or going through all the underwriting, which is huge. Worked very well.
We see it a lot too for equipment purchases. You can't run a practice as a doctor if some of your machines are down in your office and you need quick emergency funding. This could be another use for that. We see that a lot, especially in like x-ray equipment, when you need repairs, when you need some sort of any type of work that needs to be done. This could help facilitate funding in a quicker way. And the reason why I say that is because if you have this line in place and let's just say an emergency occurred in the morning and you're like, all right, I need this money tomorrow to make payment to a vendor who's coming in to repair it, you could have the money wired same day to your account. And it could be great for that purpose in an emergency situation.
I know a lot of our listeners, John, are personal injury doctors too. That's quite a lengthy process. If you're waiting to do a settlement from an accident, you're waiting from the attorney's check or the insurance company to pay the attorney, and then they pay you. And some of those cases could take up to 2-5 years to get paid. So a lot of times for even short-term cash needs, you can use it for those scenarios too. Then just reimburse it when you get your funds, which is huge.
Yeah, that's a great idea. There are different avenues that you could use for liquidity needs. This just seems to be not only from a rate standpoint, but just access and ease of setting it up. It's really about educating the public that this is out there, it's available to them, and it could be used for multiple purposes, like you had said, Kevin. I think there is a real lack of exposure to this, and it could be really beneficial in emergency situations. And acting as a vendor or liaison between you and your clients, or however it's structured that these types of opportunities come into the Bancorp. We've been doing this for over 21 years, this particular line of credit. So we see so many different cycles around rates and things like that. We just think you're in a competitive environment when it looks like from a rate standpoint.
Excellent. Before we pivot, I would like to talk about life insurance too and how you can use this in life insurance. But before we get there, do you have a story or so that you could share? Maybe something that went bad or something painful, and if they would have had this, the pain would have gone away or something like that?
Yeah, we see, if you look at like an attorney situation, like you had mentioned before, I've had attorneys that they get lump sum payments, and then when they get those lump sum payments on cases, sometimes they don't know what to do with it, and they might come to you to advise them on planning and how they go about doing it. And the accumulation phase in a practice or a profession, we see it a lot where you get an accumulation, you're diversified your portfolio, and then if you're an advisor, you might want, or you have an advisor, you might want to ask them, do you have this availability for this line of credit, which I heard on any podcast, or my friend told me. We always hear it a lot where my friend told me about it, so tell me about it. So we see that a lot. When that happens, structured properly, it could be a useful tool to bridge cases for attorneys. We see that a lot.
Yeah. That's good. And the whole point here is to keep your investments doing what they're doing and what they're supposed to be doing and growing out there in the marketplace for it as you stay invested, so that you don't have to worry about the short-term whims of the market or sell something when it's not the right time to sell something to create the cash to do it. So this is all designed to put you back in the driver's seat with some options that you might not have ever considered before hearing this podcast. So I think it's very important. Let's pivot to life insurance. How can you use this in a life insurance scenario?
Sure. Just want to go back to something I might have missed. When I originally started out the podcast about talking about titling of the assets, whatever title of the account that holds the assets, let's just say it's an individual account or a joint account that owns the assets, and those assets in that account are pledged. and now you're running your business.
Mm-hmm.
And instead of taking capital or selling assets that are in other names, you could set up a line of credit against those assets and maybe lend it to your business for a short period of time, right? And in that case, you work with your accountant. Maybe there's a promissory note or some sort of note that's issued in that process that you're taking personal assets and lending them to the business so you can document it. And then at year end on our line of credit, if you had that in place and you used it, and that the use of the line went to a business need, we do report at year end the interest paid to the bank. So you can work that out with your accountant. You might want to hand that to your accountant and say, hey, listen, this is what I did with this, just so they're aware of it. And maybe there's some options for them to work with that to structure it properly where you could take advantage of it using it against the business expense.
Great point.
I forgot to mention that to you, but I think that's critical.
It is, yes.
So now I didn't mean to go back on that. Back to
you're good.
I missed. I think that was critical. It was something that I did miss that is used a lot. That's another scenario. Yeah. On the life insurance side, I'll define, we call it an insurance-based line of credit. That insurance-based line of credit is set up against any insurance contract that has cash values accumulated in that contract. So to simplify that, if you have a whole life policy, you can go to the carrier and take a policy loan if you have cash value, or you can use an outside bank to do it. And we're one of the banks that do lend against the cash values in life insurance. So if you have $100,000 in cash accumulated value in an account, we can give you a line of credit of $95,000 against that cash value. It works the same way as a securities-based loan as far as the operational aspect of it. Access, use, how we charge the interest. The interest rates are very similar. They're prime-based, and they are below prime lending amounts as far as the rates, and very similar use purposes of use that I mentioned before. The nice part about it is getting back to a lot of people use this to fund a business. If you have a policy loan directly with the carrier does not report annual interest reporting on it. They don't even report it. They just charge you an interest rate. A lot of times our interest rate will be lower than the policy loan rate. And if they utilize that for real estate or they utilize that for business purposes, you need to keep your accountant in the loop on that. Where we see a case study on that, Kevin, is we see that a lot with doctors, or we see that a lot with professionals or business owners that might have buy-sell agreements, and they have a cash accumulated life insurance policy that's used for buy-sell or any type of protections that are needed for the business. And we see it utilized a lot with exit strategies on one partner buying out the other, or someone retiring, where they utilize the cash value in that policy that's accumulated between the two partners.
Right.
And they use that cash value to buy out the other person or transition them out in retirement.
No, that's a good use, very good use of that. Any other points that you want to mention about that?
I think the other thing is the ease of access of use. And I'll give you an example, and I'll leave it at that with the last example. And this goes with securities-based lending, and this goes with everyone's daily life. We always get brought in and asked to set this up when they needed it 2 days ago. Okay.
Good point.
On an insurance policy, if you're in an emergency need and you go to the carrier and you say, I need this money, you'll get a check sent to you and it'll be there in 2 weeks. If you set up this line of credit with us and you have this emergency need, we'll fund it today, as long as the Fed wire is open. So I could say 9 out of 10 applications that we get when we have a conversation with the borrower, or we have a conversation with the advisor or the referral source, we'll say, can you please give us some details around time frame? And they really needed this on Monday and it's Friday. When can we get this done? We take pride in our service, just like you do, Kevin, and we're glad to help anybody out.
This has been fantastic. I think, doctors, you're going to really like this concept, just to even know that it's out there. Who knows when you might have the need for it, but we want to point you to this podcast so that when you do need it, we're ready to help you out this way. You can always just email us here at the podcast too at kdsullivan@lpl.com. and we'll be able to respond to you and get you any information that you need. We'll also provide some resources. If you reach out to us, we'll give you the resources so you can have a little checklist, a little bit more of an information about what this is and how it works. Just send the email to kdsullivan@lpl.com. Any closing thoughts, John?
And what you just said to follow up, we do have material that can be provided, some PDFs that give you more detailed description of the product. The material is there if you need it. I'm glad to share it with you. That's all I got.
Thank you so much for being a guest on our podcast today. I know this has been very informative. Thank you for your time today, and I look forward to having you again back on another show at some point.
Appreciate it, Kevin. Thanks for having me.
Yeah, thank you so much. That's our podcast for today. And remember, if you're not working on your personal wealth, who is? Please share this podcast with your friends and colleagues, and make sure you subscribe, like, and share. Any questions about what you heard today, please send an email to kdsullivan@lpl.com. Physician Wealth Meds, wealth medicine for doctors.